Europe could do more, in my opinion, to free things up, to liberalize, to let the labor markets go, maybe reduce taxes, maybe integrate more so there's more scalability.
Hello and welcome to this week's Tea Break. I'm Al-Enazi and as always I'm here with my co-host Yuri. Today we're thrilled to welcome Arnab Das, Global Macro Strategist at Invesco. Arnab, how are you?
Good, thanks.
When you chose your choice of beverage this morning, Arnab, was it more of a bipolar decision between tea and coffee, reflecting your view of the world?
Well, look, I like both tea and coffee, but you have to make a choice. So I went with a latte because it's, tasty and strong, right? And I think we need a lot of strength.
I have gone for the English breakfast.
The classic.
Tea. It is the classic, but also there's a lot of focus on the UK and Europe at the moment, Ali. I was in Luxembourg chairing an event there a couple of days ago, and all of the discussion there was how do we make Europe much more efficient? So it's a contender for asset allocations against the US, but also the trade deal 9 years after Brexit. And Ursula von der Leyen was saying this is just the first step in the measures to bring the UK closer to Europe. Keir Starmer emerged very triumphant. What do you feel about disagreement? I mean, some in the UK say this is unwinding Brexit. Will this be enough to bring back British growth and make London an investable destination once more?
Look, I think at the margin it'll help. And you could say, the UK is on a bit of a roll, right? We have at least a framework agreement with the US in principle. We have a trade deal with India as well. So the EU, makes a lot of sense. We need to do a lot more than heads of terms with the US, some improvement at the margin with Europe, and even, after years, if not decades of trying with India, I think, a lot of stuff still needs to happen to make Britain great again, to raise the growth rate, productivity growth rate, and all of that. I think it's a step in the right direction, necessary but not sufficient.
And one of the measures in the agreement has been about the pesky passport gates. A 20-minute, half-an-hour queue for UK citizens and then the EU citizens breezing through. And you've been writing, Ali, about this investment migration and which passports are the most valuable ones at the moment, according to your research?
The golden visa programs face growing legal and political scrutiny, especially in the EU. The European Court of Justice recently ruled Malta's scheme unlawful, intensifying pressure on similar models. But firms like Henley and Partners, they argue demand remains strong with wealthy clients pivoting to multi-jurisdictional strategies, combining EU residency and non-EU citizenship. Countries like Greece, Austria, and the Caribbean nations remain attractive. And then on the other hand, you have the US, which is proposing a 5 million gold card, escalating competition in the investment migration space. Will the European Court ruling against Malta put an end to many of these schemes?
At the margin, we're trying to control all kinds of immigration. And so I guess in a way, it's not surprising that even this one is coming under the kibosh. I think it's also a question of tax. The UK is punishing the non-doms, in the non-domiciled people who don't have to pay the full whack of tax here historically. There's a political question because of migration and the inequality issue. The very well-off, they're going to continue to be mobile, and governments are increasingly desperate to fund all kinds of things, whether it's aging and demographics, defense, just the general budget deficits, which come and go with the business cycle. So I think there's going to be more and more pressure of various kinds in all of this. Is it going to make it all go away? No. But I think the gold card is an interesting innovation. Charge a lot for that all-powerful American citizenship. But, maybe there's a little less demand at the margin to go to the US now.
The realist competition between countries for talent, for migration, for investment. I mean, that's a real pattern that we're seeing. And my colleague Elisa, looking at family-owned businesses, she researched the 2025 EY and University of St. Gallen Global 500 Family Business Index. And in that, we found that the 500 largest family-owned businesses globally generated 8.8 trillion in revenues. And incredibly, nearly 50% of that comes from Europe, which was a bit of a surprise for us, with 5 of the top 20 companies in Germany alone. Is Europe actually in a better economic shape than we think?
Europe has always had a lot to offer. In the US, I think you've had a lot of creation of new businesses, and new families or new founders have shot to the top very rapidly in successive generations. Very clear now, but it's been going on for hundreds of years in the US. And I think there used to be much more of that in Europe. When Europe was at the technological frontier, Europe could do more, in my opinion, to free things up, to liberalize, to let the labor markets go, maybe reduce taxes, maybe integrate more so there's more scalability. LVMH, right? That's a huge company. A lot of it is global, maybe more global than European. And that's the epitome of old economy, right? Luxury, beautiful brands, beautiful workmanship, craftsmanship, not to take anything away from that, but where's the tech? I think if Europe did its bit to get very quickly back to the technological frontier, compete with the US and China.
And interestingly enough, much of the technology investment that Arnab's referring to is going into the unlisted companies as well as the listed ones.
Yeah, a lot of it is driven by generational wealth transfer, diversification needs, and market volatility. But one of our regular commentators, Yuri, that is Professor Amin Rajan, he says that the elevated returns of private markets are unlikely to persist, because interest rates will remain high to anchor inflation expectations from Trump 2.0, and default rates are set to rise. Does the hype around private markets from banks and asset managers mean that the golden era is already behind us, and that we should be looking elsewhere for diversification?
You could say diversification is kind of, in a way, it's a silly thing to recommend because that's one of the free lunches in finance that you kind of reduce your risk by spreading your eggs across lots of different baskets. But actually what we've been doing as a result of the low interest rates that we've had until recently, I think is concentrating in long-dated assets of various kinds, which really means concentrating in the US because you have long-dated equities there, right? Growth, tech, more than most other markets with possible exception of China. Now, I think what Professor Rajan is saying, I think is correct, but it's systematic. It's not about private markets. Interest rates are higher. It's going to affect everything. Yields are higher because growth is going to be somewhat higher in various places, and inflation probably going to be somewhat higher. So I think the question is, how do you diversify against that problem? And I think the answer is partly about asset classes, private credit, private equity. They have a role to play because more and more things are going to be done outside the public markets. But I think you should also consider geographic diversification, not just asset class diversification. And I think that's maybe where Europe, I hope, is going to start to come into its own again, even, touch wood, including the UK, right? I'm not convinced, but I'm hoping.
Some commentators are talking about a potential Trump slump and a stagflation that may await us in the future. And we've had an interesting piece, an opinion piece from Carmignac, investment managers in Paris, from Freddie Leroux, and he's talking about how inflation is particularly affected now by tense geopolitics, the energy transition, and changing social dynamics. So there's a lot more factors we need to look at. And I know this is very much a core part of your work, Arnab. What sort of scenario are you looking at regarding inflation and the type of assets that you're recommending investors should go into to counterbalance that?
This is kind of, in a way, it's bad inflation, right? It's about supply-challenged growth as opposed to demand being very strong. So I think it's a more kind of difficult environment for investors, for policymakers, right, for central banks that are famously best at managing demand rather than supply shocks or supply-constrained growth in general, right? I think we've been in a period of globalization where the constraint really has been demand. We've had excess supply because a lot of labor came into the global labor market from the collapse of the Soviet Union, the entry of China and India, Latin America, the reintegration. A lot of that is, starting to fall by the wayside with the social issues against immigration. And of course, like you say, Trump putting up trade barriers and tariffs and also other kinds of barriers for national security reasons. It's pretty clear the ECB is going to continue to ease in the short term because the Trump shock is disinflationary. It's a demand shock for the rest of the world. I agree with you, sort of it's stagflationary for the US. The Fed is in a bit more of a bind, at least a bit more of a bind than the ECB. And the Bank of England, as ever, is caught somewhere in between. You know, this is a relatively small, very open country. It's historically tended, when in high inflation periods, to have higher inflation than Europe or even than the US. So I think we have different stories going on in different parts of the world. So diversification, you know, free lunch? Well, not quite, but I think it's back, including the American investor for the first time, right? Because some of the things that these new sets of policies are doing in the US are going to take the shine off so-called American exceptionalism. Not to say Europe is going to be exceptional, but it's going to be, maybe it's going to be exceptional in a better way than it has been in the recent past.
And Arnab talked about the free lunch. Unfortunately, we don't get that in the FT canteen, but thankfully they're holding the prices down despite the inflation.
Thankfully, yeah. I need my lunch after this tea break. Arnab, thank you so much for joining us.
My pleasure. Thank you for having me.
That's it from us for now. Thanks for joining this week's Tea Break. Don't forget to catch our weekly episodes on the PWM website or our YouTube channel. And if you've got questions for our guests or just want to dive deeper, you'll find everything you need online. See you next week.